Hello, everyone, and welcome to today's webinar brought to you by TaxConnect. We're going to talk today about the taxability of digital goods and services. Really looking forward to diving into this program and introducing you to our speakers. We are thrilled to have with us today Jeff Meggs and Brian Greer, who are partners with TaxConnect, and they've been working together for a long while, and they have been joining us and graciously sharing their sales tax experience with us for several years now, and always get great feedback on their program. I do want to back up just a bit also and give you a few just quick tips to get the most out of the program today. Today's webinar does qualify for CPE credit. So as long as you respond to 3 of the 4 polling questions, you will earn your CPE certificate, and you can access that from your Incourse dashboard. You can access the presentation slides from the GoToWebinar control panel. And most importantly, you can use the questions box to ask questions, share your feedback, share your experience. This is a place where the TaxConnect team is very strong. We were talking earlier about how long the program might last. That probably depends a little bit on my intro here, but really, we like to answer your questions, and Jeff and Brian do an excellent job prioritizing audience questions because we know that everyone's arrangement is slightly different, and it's really helpful to you to listen to your specific scenario and situation and hear their reflections on that. So really excited to have 2 professionals who bring so much to the sales tax space. TaxConnect offers several different services. So they have a product, they can offer consulting, and then they also can help you do the sales tax for your organization. And Jeff and Brian will share a little bit more about that. So really, really recommend working with the TaxConnect team, and really excited about the webinar today. So Brian, I'll go ahead and turn things over to you.
Yeah, sounds great. Thanks, Liz. I'll kind of highlight this agenda fairly quickly, and then I think you've got a polling question that we'll get to right away, and I'll provide a little bit more background information on the company and Jeff, myself, as you guys answer the first polling question. But just from an overall agenda perspective, if you guys had been on a prior webinar with us through Incourse, stick with us as we get through the Sales Tax Nexus overview. We start a lot of our presentations with an overview of Sales Tax Nexus because it's just a critical building block for really the rest of the discussion, but sales tax in general. So we'll highlight that. We'll talk about what is the definition of a digital good. I think we've got a few examples of taxability of certain types of digital goods that we'll share with you as well. And then there's some interesting, unique aspects and differences, we say nuances of digital goods that we'll talk through as well. And then kind of wrap up with this sidicing discussion. And if you're not familiar with that term, it's basically the point at which sales tax applies. So we'll kind of wrap up with that piece of it. And like Liz said, please shoot those questions at us as we're going here. If it makes sense to take them at the time, based on the topic, we'll get to them right then. Otherwise, we'll hold them to the end. So Liz, I'll let you put that first polling question up, and then we'll talk a little bit more about TaxConnect.
That sounds good. So opening question, how confident are you in your understanding of sales tax regulations for digital goods? So go ahead and respond to the polling question, and Brian, the floor is yours.
Yeah, sounds good. And you did a good job initially kind of highlighting some of the service areas that we focus in on. But just to give you a quick overview, sales and use tax is all that we do here at TaxConnect. And I would think of us as kind of a boutique type of CPA firm focused in sales and use tax. And within that, as Liz mentioned before, there's really 3 categories of support and help that we provide. The first is that consulting or advisory service. So companies that, in this case, have questions about where they have nexus, maybe they're selling digital goods and they don't know what their sales tax requirements are. Maybe they have some prior period exposure that they need help remediating. We support all of those types of projects and questions within that consulting area. And Jeff specifically is our partner that heads up that consulting practice for us. Then secondly, and I kind of do these in sequence because you kind of look at, what are my requirements? Then how do I charge sales tax? So we have a software solution that integrates to your billing system or to your shopping cart to make sure the right tax gets applied to the shopping cart or to that invoice. And then the third piece of the puzzle, we have an ongoing compliance outsourcing service where we essentially become an outsourced sales tax department for you and manage the process on a go-forward basis. So that's a quick perspective. If you want to close the poll there, Liz, and then we can get going.
Yeah, that sounds good. Poll is closed. Good mix, but definitely a lot of folks who are in a spot to build confidence, and so that's why we're here.
Perfect. So Jeff, I'll let you get us started here.
Thanks, Brian. Thanks, Liz. As Brian said, we will touch on Nexus. It is kind of almost a comedy show when we start to kick these things off, and we always talk about Nexus. It's kind of my least favorite and most favorite topic at the same time. So when we're talking about Nexus, what we're really talking about is, to what degree does a state have the authority to impose its taxing regulations and rules on a company or an entity? There has to be some either physical or economic connection with that state before you have to comply. And for sales tax purposes, historically, that was, or traditionally at least, was a physical presence test, meaning you had to have some degree of physical activities, and those could be either permanent or temporary activities in the state for a state to legally be able to impose its tax laws on you. A few years back, we found that the states were finally successful at legislating an economic nexus standard. And as a result of that, companies, particularly in the digital goods arena, were probably most impacted, along with e-commerce in general. And the economic nexus standard took it a level past physical presence and said, if you have revenue generation from a state, and for the purposes of this conversation, we'll use $100,000 a year in gross receipts, that in and of itself was enough to trigger nexus for sales and use tax purposes. And again, you would be under the authority of that state for purposes of compliance with those laws. Now, of course, nexus in and of itself is not a sales tax matter per se. In other words, you can have nexus in any number of states, but you may not have any type of obligation for sales and use tax purposes. It is a first step in determining or identifying to what degree you need to analyze your business for sales tax purposes. So that's why we like to just kind of talk about it and give a refresher on why it's important. So I typically leave people with the idea that if you've got an opportunity every 6 months or so to look back at your revenue activity as well as physical presence, they're both still in play, but to take a look at your revenue, and as you're eclipsing that $100,000 mark, it's when you should start really analyzing your activities, maybe confirming that particular state's nexus threshold. Those of you that are looking at the map here, the reason we do have the map and the reason you see a few states shaded a different off color is there are 5 states that don't have a state sales and use tax, those being Delaware, New Hampshire, Montana, Oregon, and I saved the last for Alaska. Alaska does not have a state sales tax, but the reason it's got a little bit of a different color is there are cities within Alaska that have their own sales and use tax. So they administer and legislate sales and use tax at a local level in Alaska. All of the states today have some level or degree of an economic nexus standard. There's nuances across the states in both the definition of gross receipts or what receipts are includable, and there are also some different thresholds. California and Texas, for example, have a $500,000 threshold. So it's just important to have a feel as to where your business is actively engaged, whether that be with sales reps visiting the state or, as I said, the pure revenue aspect of it.
Yeah, one comment here, Jeff, and a quick question as well. You mentioned the transaction counts as well as the revenue associated with the revenue source into the state as potential economic nexus triggers, and kind of focus on that revenue aspect of it, because we've seen a lot of the states start to repeal their transaction counts. Historically, we've seen a lot of the states have a 200 transaction count threshold, and I think one of the good things that the states have done to try to simplify things, usually when they try to simplify things, it actually makes it more complex. But in this case, I think they did the right thing by starting to repeal these transaction counts, because there were too many businesses that had 300 invoices worth $1 a piece, or worth $5 or $10 a piece, where the revenue and the tax liability was very immaterial. So we've seen a lot of states really start to focus on that revenue threshold. The question that came in from the audience regarding that $100,000 threshold, do you see that from a time frame perspective? Is that per year, rolling 12 months, previous year, current year? What is that? All the above?
Yeah, a little bit of all the above. Most of the states, the way the language is in their statutes is that anyone that's exceeded that threshold in the prior year or during the current year. So in essence, I like to say that I would review it on a 12-month rolling basis to be safe. Again, I wouldn't necessarily look at it every single month, maybe twice a year, depending on how fast your growth is, maybe more frequently. So that's generally how they look at it. Some states are purely prior calendar year, so I don't want to leave you with the impression that that isn't a category of scenarios.
All right, we'll move on to the next topic here.
Yeah, so as we were talking about Nexus, the challenge that states have had over the course of time is, again, the digital world that we've all started to see evolve and really take off. It impacted the need for companies to travel into other states. It impacted the need for companies to have brick and mortar, thus lessening the Nexus footprint of a lot of companies that could operate in the cloud. And so when we think about digital goods in this context, it does have a fairly broad range of definition, but in essence, it's really anything that can be delivered in electronic fashion, whether that be through cloud systems or through digital services that you might be subscribing to, or some of the data elements on all of our phones. Examples, as you see listed here: digital photographs, music, movies, streaming, whether it's live or recorded streaming, information services, and finally software and SaaS. For the most part, the companies that we work most closely with are impacted on the software SaaS level. I mean, essentially all of us are engaged in downloading software over the internet for personal use, and businesses are commonly doing the same thing, whether it's downloaded or in a SaaS model, software as a service model. So the states, again, looking at Nexus differently over the last several years, and now you will start to see, and we've already started to see a little bit of a move towards more aggressiveness around digital products. And then you do get into some complexities around how these things are taxed, which we'll talk about here in just a moment. But in essence, anything that's achievable electronically has the potential to be deemed a digital product or a digital service from a state sales and use tax perspective. And the last thing I'll say is, just because we're talking about it, and just because we're emphasizing it, it doesn't mean that all of these items are taxable in every state. There are still a good number of states or a good number of scenarios within states where certain types of digital products are not yet taxable or subject to sales tax.
So Liz, if you want to pull up that next polling question.
That sounds good. We'll go ahead and launch the second polling question. In your experience, what is the most common misconception or misunderstanding about the taxability of software as a service?
Yeah, and while the audience addresses that, we're talking primarily about sales tax. And when we get into some of the nuances a little bit later, it's interesting to see that there's some other types of taxes that apply to some of these transactions that in some scenarios actually have a communication services tax associated with them. So interesting that we're going to end up talking a little bit more about not just sales tax, but some other nuances and other tax types that you have to be aware of depending on where you're selling these types of products.
Very good. Well, we are almost ready to close the polling question here. We'll give you all about 5 more seconds, and then we'll take a look at the results. Thank you, everyone, for responding. So the results here are a little bit more split across the board. In your experience, what is the most common misconception? And so it seems as though the top response is the most popular, that SaaS is always exempt from taxation. That's closely followed by SaaS tax regulations are consistent across industries. So let's go ahead and dive in, because it definitely seems like we have many misconceptions, and it's good to have some clarity here.
Yeah, I think we're going to surprise some people as we talk through this, just in terms of specifically on that SaaS piece of it. But go ahead, Jeff.
Yeah, this next slide, when we get to discussing taxability, is interesting for a couple of reasons, and I think what you heard from Liz and Brian there are kind of hinting around this. The challenge that Brian and I have more often than not, and are addressing these types of situations for our client base, is really defining what it is they're selling. The more digital products that exist, the more electronic transmission of products and services that are out there, the harder it's actually become for me personally to distinguish a certain type of product between certain, maybe let's say a SaaS product versus an information service. How is that differentiated? What are the key elements or attributes that decide whether or not the state's going to treat it as one or the other? So it's interesting, because a lot of times we'll start a conversation with a company and they will wholeheartedly come to the table with a SaaS product, and by the end of the call they have an information service or another type of service. It's really not what the state would deem to be a true SaaS offering in the context of sales and use taxes. And that can be good or bad depending on the circumstances and depending on the states they're operating in. We won't probably go anywhere near the depth in this discussion today around some of the nuances in regards to distinguishing between those services, but we would like to talk about a few of these here. Information services. Generally speaking, what we're dealing with here is information that's consolidated, collected, and then published in an electronic form or fashion for consumption by customers or consumers. And there's a couple of differentiating factors here. One, generally speaking, there isn't a significant software component to an information service. And when we say a software component, what I really mean is we're not inserting or loading data into this service provision in a way that the system is processing that data and giving us some different type of output. Now, there's certainly searching criteria or indexing circumstances that exist in a lot of these information services. But generally speaking, we're talking about data that's, for the most part, available in our society through different avenues, and that there are companies that really specialize in consolidating that data and then presenting it in a fashion that's very meaningful and efficient and effective for their consumers. One of the things about information services that are distinguishing within that framework is information that's personal in nature. So the states, a lot of times, those that tax information services delivered electronically will have a caveat or a carve out for things that are personal in nature. And personal in nature could be personal, like my healthcare records, or personal in nature could be something that's very intimate to the company. It's company specific data. So when a company is in a position where they've collected data that's very intimate and specific and only available for that person or that company, and then they take that data and massage it, translate it, and present it back to the customer in a certain fashion, it can still be an information services, but the states, as I said, a lot of times will carve out that real personal in nature data as compared to generally available data in the World Wide Web, let's call it. So we find that there's roughly half the states that impose a sales tax are probably in some form or fashion taxing information services. Then we get into software, and there's two prevalent software options in this regard, one being downloaded software, which is the most prevalent historically for most of us, especially us as end users. But SaaS, of course, has become the real primary target for states from a sales and use tax perspective and a software perspective of late. Downloaded software, for the most part, I'd say 2/3 of the states or more tax downloaded software. Those rules and laws have been in place for a few decades now, pretty clear and concise. SaaS, on the other hand, there are still states trying to catch up. And so a lot of the legislation is a little more broad, and you end up having to rely on administrative interpretations or legal precedent to get down to the level of SaaS specifically. So most of the states, I would say, have done a really good job of putting forth some administrative policy or regulations that give taxpayers an opportunity to understand and interpret the applicability of sales and use tax to SaaS pretty clearly. But there are still a handful out there that just aren't clear. Minnesota, Alabama, their language is really a little bit ambiguous in this regard. And if you call them and ask them, you won't get a straight answer. They'll point you to some regulations or things, but it's very challenging. So what we find happens is we kind of look at the landscape of what companies have been audited under those circumstances, how the states have treated them under audit. We've looked at the consistency across the different tax calculation platforms and software applications that are out there. And so we've kind of consolidated information and experiential knowledge to drive our conclusion in determining whether a SaaS product is taxable. But SaaS is catching up to downloaded software. There's a handful of states that do tax downloaded software that still don't tax SaaS. But again, states are kind of catching up to themselves in that regard.
So Jeff, here's kind of a wild card question that I'm throwing at you. Where does data processing fit into all of this? Is that kind of what you were talking about in that the
Yes.
private, non-private data aggregation and
Yeah, what you'll typically find is that data processing has its own distinct category within the statutes. And in those states that tax data processing services, what they've done is they've kind of connected SaaS to that language, to that legislation. In other words, they'll basically, from an administrative perspective, give a perspective that says SaaS is deemed data processing services for sales tax purposes. And so you then go back to the data processing rules, and if they're taxable, SaaS is therefore taxable. So we have seen that sort of thing, and we're going to talk about a few of those nuances here, I think, in another slide or two. But yeah, I think most of the challenge that Brian and I experienced today, as I said at the very beginning of this slide, is evaluating what it is that company is delivering. What is that service? And a lot of companies are very confident in what they believe they're providing. And when we really break it down, there's the element of what the customer receives, the benefit of what the customer receives, the true object of what the customer desires. And then there's the effective transaction. How do we deliver it? How do we execute? So again, challenging area. Sometimes I think we assume it's black and white. And I think Brian said, you might be surprised. I didn't probably give you too many surprises in that, but I think the surprise is some of you on this call might believe you have a SaaS product that might not be, or vice versa.
Yeah, a couple of thoughts there. I've talked with people that just because they're billing something as a subscription, that they associate a subscription with SaaS and they call it a SaaS when it's really not. So the billing can influence the taxability, but not necessarily. And I wish I could remember the specific example. It was fairly recently, a couple of weeks ago, 3 weeks ago, and the business was, they initially came in, I don't think they said that they're delivering an information service, but they felt that it was something similar to an information service. But as you start to kind of peel back the layers and really find out that they're a user of the information service, but they're actually providing a consultative analysis report based on the client situation, but they're using all of this information that they subscribe to. So they're not reselling that information per se, but they're consuming it in the delivery of their service. Probably similar to the way that we consume a tax research product to deliver taxability studies. All right, so let's get into some of these nuances.
Yeah, I think, the overarching message, if you're in the business that is delivering some degree of technology or digital products or digital services, the nexus implications are the sort of big red light that's showing up. And we have other presentations that we do where we talk about mergers and acquisitions and prior period exposure. And companies in this digital space find themselves quite frequently in the due diligence process of an M&A exposed in this area. They don't realize the extent to which they've had nexus and had taxable activities until they get to that due diligence effort. And the buyer says, whoa, you guys have been operating in multiple states where your product or service is deemed taxable for a number of years, and you've accumulated pretty heavy risk, and the buyer doesn't want any part of that. So it's going to be negotiated out, whether it's a reduction of the sales price or whether they force mitigation of those liabilities and exposure. So the nexus implications, they're just so important to think about. And the reason that is, if you're wondering, okay, well, tell me why it's so important. Yeah, you talked about the revenue, but hey, I'm in Colorado, let's say, and I've got a server and it's sitting in the closet of my office here, and I put my SaaS on that server. And so all of my customers are accessing that SaaS here in Colorado. And at the state level in Colorado, SaaS isn't taxable. So why do I have to worry about this? Well, the citusing rules, which we'll talk about towards the end of the presentation, will dictate that you're going to look to the benefit of use. Where's the customer's benefit of use occurring relative to that SaaS that's sitting on that server in Colorado? And if that customer is in Oklahoma and they're accessing it via the cloud and performing calculations and processing data, they're actually getting that benefit in their home state of Oklahoma. So it's the actual Oklahoma state sales tax rules that are going to be imposed on that transaction. So then you got to go back to the equation of nexus. Do I have nexus, yes or no? If I do, I now need to know whether Oklahoma taxes SaaS, and I may have an obligation to comply there. even though I reside in Colorado as a vendor.
And that benefit of service isn't just a SaaS issue. It goes to all of these digital goods, like the streaming services. We've got a question on streaming that I'll get to here in a minute, but where you're located in terms of where are you viewing Netflix or Amazon Prime or whatever, as well as these other digital products like the photographs and the music downloads. It's where you are.
Yeah, and when we think about it on an individual use level, it's not that complicated. When you get to a business that's operating in 30 states and their headquarters is in New York, where they do all of their consolidated contract work, they're buying in bulk seat licenses in the thousands sometimes that are being used by employees spread out across the country. So it gets complicated very quickly in that environment. Wanted to just kind of highlight a few of and again, I think we'll talk more about software in some of these cases, intentionally so, just because we tend to find that's where a lot of our customers have a lot of their challenges. So the states with exceptions here, Connecticut, for example, they have a 6.35% state sales tax rate, but for businesses that use SaaS or electronically downloaded software, that rate is reduced to 1%. So big advantages for business use in that regard. Illinois, a couple of nuances there. At the state level, electronically downloaded software is generally taxable. However, the state has proposed there's 5 criteria that if a contract to acquire downloaded software meet these 5 criteria, and I really will not be able to go into those 5 criteria today, but if you need them, we'll be happy to supply them to you. If they meet these 5 criteria, and by the way, they're not difficult to meet. They have to do something with signature, a wet signature on a contract. They have to do with you're going to replace the software if it's lost or stolen, or if the software expires, the customer doesn't retain any ownership rights to it. It's things like that. If you meet all 5 of those criteria, then Illinois exempts downloaded software. And at the state level in Illinois, SaaS is not subject to state of Illinois sales tax. However, the city of Chicago has taken advantage of that and has kind of come in and said, hey, we're going to, and this is historically, because I'm getting ready to throw a little wrench in the mix here, but Chicago has historically taxed SaaS as a non-titled personal property tax lease. And they define non-titled personal property tax to include SaaS, and it's 11% rate at the city level. And the city itself has its own nexus rules. So it's just important to keep your eye on things when you're operating in the state of Illinois. And the little wrench that I was going to just mention to you is there's also in Chicago another property lease type tax that is imposed, and the state of Illinois historically has not had a retail sales tax on leases of tangible personal property. But effective this year, I think it may have been July 1st, Illinois did institute a sales tax on leases of tangible personal property. And there's still this Chicago lease of tangible personal property tax sitting out there. So when you start researching this, if you do go about researching it in the city, you could get confused a little bit with some of that terminology. So I just wanted to throw that at you. There's a little bit of weirdness going on right now in the leasing category in Illinois. New Jersey, and this is true in a couple other states, Iowa, if the SaaS is business use, it's exempt. I'm sorry, if the electronic downloaded software is business use, it's exempt. SaaS is not taxable in New Jersey in general, but electronically downloaded software is taxable unless it's business use. South Carolina kind of has a backwards feel to it from my perspective. I'm used to states that have sort of developed along the way of technology. They started with software delivered in a tangible medium is taxable, and most of the states then adopted taxability of electronically downloaded software, and then they adopted taxability of SaaS. Well, in South Carolina, the state doesn't tax electronically downloaded software, but they do tax SaaS. So it's a little bit backwards in that regard. Texas, back to Brian's question earlier about data processing services. Texas defines SaaS as a data processing service. And in their data processing law, 20% of the charge for data processing is excluded or exempt from Texas sales and use tax. So if you're invoicing for SaaS, 20% of that invoice should not be taxed. And Maryland's trying to figure things out. A couple of years back, they did institute a tax on SaaS, and then a few months later repealed it, and they're back again. And this time they've instituted a reduced rate. The Maryland sales tax rate is 6%, but they've introduced a 3% reduced rate tax on SaaS. So that's a relatively new phenomena there.
Jeff, I'll touch on streaming a little bit, and I referenced it earlier, but we've got a client, they're based in the UK, and they provide live streaming services into the US for various individuals that sign up for these streaming services, primarily around education is what this company is doing. And when we first started working with them, they had a tax engine in place, and it was actually a tax engine based in the EU that wasn't familiar with all of the sales tax nuances in the US and didn't recognize some of these non-sales tax related charges that apply to streaming services. And in this specific example, they were conducting business, they had customers and had reached the economic nexus threshold in both Illinois as well as Florida. And Florida has the communication services tax, which is typically associated with cell phone bill or a VoIP bill, any kind of what we think of as real telecommunication services. But Florida has kind of swept this streaming service into that CST area, which is different than sales tax, has different rules and rates that apply. I think it could be
much more,
as 12%, 13%.
It can definitely be that, and it's very complicated. It's actually 3 to 4 levels of tax within one. So when we say communication services tax, there are multiple components to it. Yeah, very good point.
And in this same case in Chicago, they treat streaming services and apply an amusement tax to it. So again, you'd never think of, I owe this amusement tax. I don't know what the rate is on that, but it was, another thing where sales tax wasn't necessarily applicable. And I think, in fact, sales tax didn't apply in Illinois.
At the state level. Yeah.
Amusement tax does apply. So there's all kinds of these weird nuances that I think you got to be aware of. All right, so Liz, if you want to pull up the next polling question, and then we've got a couple of questions here from the audience that we can get to.
Sounds good. The third polling question is open. Have you seen a change in the number of sales tax audits your company has experienced in the past 2 years?
Yeah, so one of the questions, and I think it came up as a result of me mentioning this subscription example. And when I shared that, I was thinking of scenarios where clients or prospects are actually delivering electronically downloaded software. They say they bill for it on a subscription basis, and they come into that conversation relating subscription to SaaS. But when you really kind of unwind it, you find out that it's really an electronically downloaded software. So really the only point I was making there is that the terminology subscription doesn't define what the product is. It doesn't mean it's SaaS. It doesn't mean it's a streaming service. It's just the way it's being billed, and you really have to kind of get inside what is actually being provided or delivered to that end customer. Now this one is pretty interesting from Janet, and she asked, we provide a network security product. So I immediately go to a tangible personal product of some type. We provide a network security product to the customer in the form of SaaS. How do we classify this? So I'm thinking it's some type of device that has software that's running on the device and you're selling it kind of as a bundle. Might not be the exact answer or scenario that she's referring to, but what are your thoughts on that?
Yeah, I probably would go a little bit of a different direction in answering that question. And it's because just yesterday I had a client send me their tax mappings in a tax calculation product that they subscribe to and that they've integrated with their billing system. And they had something similar and had coded it to a category of security services within this tax calculation engine. What happens a lot of times in that regard is the security systems, at least in this particular service that they had subscribed to, the security services that were captured by that tax calculation solution were like armed security guards standing outside of your building, making sure nobody's breaking windows. That was the kind of security that was intended by that code. And to Brian's point, what you really have, and to this question, oftentimes is a cloud security monitoring type activity that could be associated with a device, like a firewall might be in a device capacity, which also has the software loaded. It could also be in an infrastructure such that your processes, emails, whatever else you might do electronically in your business, have to flow through this software, or at least this software looks at each and every transaction to identify fraud, viruses, ransomware type things that might occur. So it's very common for the security stuff that we see today, cloud-based security, to be a SaaS and actually be treated as that. And really what's happening as well, and this, there's a depends kind of comment in all of my answers. But one of the things that we're kind of assuming is that our customer is licensing or at least subscribing to that SaaS product, and that essentially they're using it. They're actually deploying it against their business, notwithstanding the fact they don't have physical possession of it. And so that software kind of monitoring things that are happening electronically within the business can easily be categorized as a SaaS product.
All right, so Janet, if that didn't get your question 100%, look us up afterwards, and happy to talk to you about that. Liz, you want to close the poll there? Very good. All right, Jeff, I think we're on to vertical services.
Yeah, so
this is actually a question that somebody had.
Oh, is it?
How? Keep going.
You can roll it in. So, Brian was talking about talking to companies over in Europe, international-based companies. When they start finding themselves in the crosshairs of state and local sales and use tax because of economic nexus, they get really, really nervous. And this slide's going to be sort of a reason why. And this slide's also a reason why we like to start with the nexus analysis for any of our clients. Some companies will come to us and say, hey, I need you to tell me the taxability of these products and services in all the states. And determining taxability is a much more involved exercise and typically much more time consuming. And you don't need to go down that path if you don't have nexus to begin with. That's why we start with nexus. Nexus is kind of a yes or no. It's a toll gate. You don't go into the building until you get through the toll gate of nexus, and then you start analyzing all the different furniture and elements of the building that you're encountering. So in this case, what we're talking about are vertical services that are associated with digital products. And again, we'll probably rest ourselves pretty solidly on a software platform in this conversation. The first one being consulting on the purchase of software. So there are some states that will say that if I've been consulted by a vendor who is also the seller of software, that consulting service, notwithstanding it's separately stated, not even withstanding that it's been separately invoiced could become taxable because it's associated with a taxable software application that they've recommended to me. Now, I'll have conversations about some of these nuances from time to time, and the next one's another category, installation. So I'm going to bring these two together here in a comment, just one moment. So consulting on the purchase of software could be taxable if the software is taxable that you're selling. Installation or implementation or configuration services, we kind of bundle those together. They all have sort of a little bit of different meanings depending on what kind of software we're talking about, but they're all associated with typically licensing software or subscribing to software. And it's that service to kind of get things working, make sure sometimes it's involving some customization, which generally would not be taxable. Sometimes it's simply moving toggles or turning dials within the software itself just to make it so that it fits within the components of your ERP system. In any case, a number of states will say that these installation and configuration services are in fact taxable if associated with the sale of a taxable software product. And both of these first two items here, one of the things that I'll start to think about in terms of the logic. And again, companies come to us and say, hey, that's professional services, and we believe professional services aren't taxable. I don't disagree that they are professional services to a certain degree. And by the way, when I think about professional services, it's a little bit different than this kind of stuff. I call these consulting services. Professional services, in my opinion, come into 5 different categories. And these are categories where special licensing or special education is required. That being a doctor, a lawyer, a CPA, an engineer, or an architect. Those are the 5 primary professional service categories that I think of when I use that term. Back to this conversation, though, in terms of these vertical services, when they're associated with a taxable product, the taxability of these items is protecting the integrity of the transaction. Otherwise, what I could do is take the otherwise taxable software and reduce the price to my cost and put all of my profit margin over into the vertical services. And I can make those vertical services mandatory. That's a mandatory configuration service you have to buy if you subscribe to my service. And so I could theoretically scheme the system and try to bifurcate a transaction in a way that benefited both the taxpayer and the vendor, or the customer and the vendor, and disengage with the state's intention. So those types of items you got to be a little bit careful with and understand they could be taxable. I already mentioned customization. Generally, a separate charge for pure customization of software is not taxable. Historically, customization, it went through a lot of iterations across a number of states in terms of what is customization and to what extent is it exempt from tax, because usually it is exempt from tax. And today, what we see primarily is a standard pre-written software application on which some customization is performed, rather than a full-blown custom software that's being built for a particular company. In any case, those separate charges for customization, generally speaking, can be segregated and exempt from tax or excluded from tax. Again, there could be a strategy or a scheme opportunity there as well. The last category has to do with maintenance agreements. And so it's very common, Brian and I both have had this experience. We're on a phone with a client and they say, our maintenance agreement's taxable. That's a hard question to answer because of these sort of subcomponents. Is it mandatory or is it optional? Does it include updates or is it only the support? So you've got to answer a lot of key questions in most of the states before you can determine the tax treatment. The other part of maintenance is, am I maintaining software that I sold, or am I maintaining software of a third party that I didn't have any involvement with selling? That too can impact the taxability of the software maintenance agreement. And lastly, something we talked somewhat about on an earlier slide is sales tax situsing. I've got a transaction that involves SaaS. I've got to invoice it. I've got a bill to address, and I know, or I happen to know, and maybe it's even on the invoice, where the user is actually located, or users. And some invoices, if we're selling tangible personal property, you're used to seeing a bill to address and a ship to address. We don't see that much, obviously, in the digital world. We typically just see a bill to address. But if you do happen to have a ship to address, particularly if it's downloaded software or on-prem software of some sort, it's that ship to address. It's where that product is being delivered that is going to be the taxable situs. When it's not downloaded software and it's SaaS, that's when the benefit of use terminology comes into play. Where is the customer's benefit of use? There are a couple of unique scenarios, by the way, in terms of the location of the software, the location of the server on which SaaS is maintained. And those two are Mississippi and Florida. If your server is located in either of those states and your customer is located in either of those states, it is very likely that if you're delivering a SaaS solution, that will be a taxable event in those states. Otherwise, if the server is not in Mississippi or Florida and your customers in either of those two states, SaaS is generally not taxable. And the last bullet or comment that I'll make is, I'm going to use an example to illustrate this. Let's say I'm selling to a customer, again in New York. I think I used that example earlier. SaaS is taxable in New York. So I sell a 1,000-seat license or subscription service to a New York customer, and obviously I've got a bill to address of New York. I might happen to know that that customer has users spread out across multiple states. It might even be in the contract somewhere that they are going to have users located in a lot of those states. What you want to be careful of is the idea that you now, with that knowledge, have an obligation to bifurcate your invoices across all of those states based on location of the users, and therefore evaluate your nexus in each one of those states and evaluate the taxability in each one of those states, all on a single invoice. You do not want to do that. You want to put your fingers in your ears and cover your eyes when there's a discussion about where the seats are going to be used, and really use the the bill to address as your primary situsing. And what will happen is, if that customer looks at that invoice and says, well, there's no way I'm paying all that tax because I got users in a lot of states that don't tax SaaS, they can execute what we call a multiple points of use exemption. And that comes in different varieties in and of itself. Some of the states have specific forms that are referred to as MPUs, multiple points of use certificates. Other states will just have legislative language that can be leveraged, and you can send a letter. The customer can send you a letter that says, here's on this particular invoice, 80% of my users are outside the state of New York. We will take on the responsibility of addressing those specific users and tax. All we want you to do is tax us on the 20% that's used in New York. So there are some really challenging aspects to situsing digital products, some of which you can manage really effectively, and some of them you can use to your advantage. Meaning, I might opt to do that sort of, I'm going to use their bill to address, but if I'm audited in another state or in that state and I haven't complied with the sales tax law, I might then use all of that data to debate, mitigate, or reduce my audit assessment. So we've had numerous occasions where that was employed to kind of mitigate the liability, notwithstanding the fact that at the very same time, I'm telling my client, don't break out your invoices by state or by user location.
All right, so Liz, I think this is the last polling question, and then we got time for a couple of questions here.
That sounds great. Here is our fourth and final polling question. Are you interested in learning more about Tax Connect? So if you'd like someone to contact you, if you are looking for education, you found the right place. please go ahead and just let us know. This is a way that we would like to make it easy for you to get in touch with the Tax Connect teams. It's great to see so many questions coming in. And if you want to dive a little further into your question, or if you have a question that we didn't get to today or that you didn't get to ask today, feel free to let us know, and the Tax Connect team would be happy to reach out and continue the conversation. We do have a little more time, so I'll leave the polling question open for about 20 more seconds, but let's go ahead and segue right into Q&A.
So Jeff, if someone were super interested in researching all of these tax rules and administrative policies on their own, what tools and resources would you guide them towards, other than calling us?
Well, we actually publish at no charge on our website taxability of SaaS, and also the economic nexus thresholds. So there's a resource for you there. I hate to say this, but Google AI is quite effective. If you really are looking for something fairly specific to a state, a single state, leveraging and just asking Google that question and leveraging the AI component is going to get you pretty close, if not on target with the answer. I don't necessarily believe that to be the best resource to utilize, and I do find it not to be accurate at times. It's obviously predicated on other positions or statements or determinations that are out there available for it to resource. We leverage Checkpoint, which is a Thomson Reuters product. The states, in a lot of cases, do a pretty good job of publishing things within their own websites that you can leverage for determination as well. So I'd say there's a lot of free resources out there that can be leveraged. What I would not leverage is calling a state and talking with a representative and telling them what you're doing and asking them to tell you how the tax treatment should work. Inevitably, there's going to be something lost in translation. They're not going to really have a vested interest in making sure they truly understand what you're selling. And they're going to draw some conclusions really to a simple way of giving you an answer. And that is not binding either. So that would be the last place I'd go. I do not call states to talk about. When I need to interpret, I just don't do it. There's no value in it.
Yeah, and as we mentioned earlier as well, you've got the whole concept of what is it that I'm really selling. And you described that's the biggest issue, is defining that. Because once we know it's a information service or a streaming service or whatever it is, you can pretty readily get to the taxing answer. So that would be the caution of using any of those tools, is that, yeah, you might be able to get the correct tax for that type of product, but is that really what you're selling and providing? So just make sure you take a look at that. We've got some super specific questions in here that I'm not going to try to get to right now. Liz, you might want to just wrap up here in terms of how people get access to their CPE certificates.
Yeah, that sounds great. So just as a quick reminder for those of you who qualified for continuing education credit, you'll be able to access your CPE certificate 1 hour after the end of the program. So check your in-course dashboard. In 1 hour, you will be able to access your CPE certificate, access the handouts for today's program, and then also we will upload the program recording later on this afternoon. So if you want to listen back through or share it with your teammates, colleagues, clients, you're welcome to do that. When you close GoToWebinar, a course survey will pop up on your screen. We always appreciate your feedback. And then I want to emphasize, for those of you who asked questions, that's awesome. We're so happy to see that interaction, that engagement. And thank you, Jeff and Brian, for answering so many of the audience questions. And I would really encourage all of you to check out the Tax Connect's website, book some time with the Tax Connect team to continue the conversation. They definitely are very knowledgeable, as you can tell, and very willing to help you out. So that brings us to the end today. So thank you so much, everyone, for joining us. And thank you, Jeff and Brian, to you and to your whole team for making the program possible today. We'll look forward to your next program.
Thank you, Liz. Thanks, everybody.
Thank you. Take care.